Welcome to The Explainer. Today, we're putting on our equity analyst hats and diving deep into a rigorous, step-by-step intrinsic valuation of Kodiak Gas Services, ticker KGS. We are currently facing a classic Wall Street disconnect here, a massive, glaring gap between current market pricing and fundamental intrinsic value. We're going to deploy absolute valuation models, look at relative peer multiples, and break down their cash flow to determine exactly what this stock is actually worth per share.
Okay, let's dive right into this framework. We'll be tackling this in 5 parts: the paradox hook, absolute valuation using DCF metrics, relative valuation through market multiples, dividends and cash flows, and finally, our intrinsic value synthesis.
All right, kicking things off with Section 1, the paradox hook.
85.07%. I mean, wow. That is the year-to-date return for KGS right now. By absolutely any standard, that's just a massive momentum run. The stock is currently hovering right around $68.54, which is literally just pennies away from its 52-week high set back on May 1st. The market clearly loves the narrative right now. But as focused equity analysts, we've got to verify if this sky-high price is actually justified by the underlying cash flows.
And this right here brilliantly illustrates our core paradox. As they say, price is what you pay, but value is what you get. So we've got this momentum-driven trading price of $68.54 sitting right next to a calculated intrinsic fair value of just $30.02 based on our source data's discounted cash flow metrics. I mean, how can the fundamental fair value be less than half of the current market premium? Well, let's break down the models.
Moving right along to Section 2, absolute valuation, specifically looking at DCF metrics. Now, what's really interesting about this is what happens when we run the absolute valuation models. A discounted cash flow, or DCF model, basically projects future cash flows and discounts them back to today's value, using the company's weighted average cost of capital. If we model intrinsic value strictly on projected free cash flow, the math spits out a fair value of $30.02. And if we run a secondary model using the earnings per share base, which is often a much more fragile metric because of accounting adjustments, the fair value completely collapses to just $8.69. Both models definitively signal severe fundamental overvaluation compared to that $68 trading price.
So what does this all mean? Well, it gives us a margin of safety of negative 128.28% on our primary free cash flow model. In the valuation world, your margin of safety is basically your shock absorber against modeling errors or sudden macroeconomic shifts. A heavily negative margin like this means there is absolutely no buffer for error. Investors are paying a massive premium for future growth, and if the company misses even a single projection, the quantitative floor is a very, very long way down.
Let's pivot over to Section 3, relative valuation and market multiples.
Here we're comparing the stock's current price tags against its own 3-year historical baseline to see if this premium is justified. The trailing PE sits at 78.78. That's a 30% markup over its historical norm. And top-line metrics? They are even more stretched. Price to sales is at 4.62, which is almost a 69% premium, and price to book is nearly 63% higher than average. Across the entire board, the market is assigning multiples far, far beyond its historical ceiling. And it doesn't stop there. If we look deeper into enterprise metrics, specifically EV to EBITDA, which is absolutely crucial for capital-heavy companies since it strips out debt structure, we're looking at 12.56. That's a 24% premium. The PEG ratio, which factors in the earnings growth rate, has spiked to an alarming 1.85. Honestly, the solitary glimmer of hope here is the forward PE of 25.45. This tells us the market is almost entirely forward-looking right now, aggressively pricing in anticipated future earnings just to justify today's valuation.
All right, Section 4, dividends and cash flows.
When we evaluate the company's financial health, we run into a pretty glaring quantitative anomaly. Over the trailing 12 months, Kodiak generated a really solid $284.2 million in free cash flow. But if you look at standard screening tools, you'll see a dividend payout ratio of 211.24%.
So you really have to ask yourself, mathematically, how on earth can a company sustainably pay out 211% of its earnings to shareholders? In traditional asset-based valuation, a ratio over 100% means a firm is essentially cannibalizing its own balance sheet or just piling on debt to fund the yield. But we actually need to look past the standard accounting conventions here and follow the actual cash.
So the crucial point is that the discrepancy really comes down to non-cash accounting charges, like depreciation and amortization. Those are notoriously high in infrastructure businesses, and they artificially drag GAAP net income way down to just $78.5 million. But remember, dividends are paid out of actual liquidity, not accounting net income. If we recalculate this using a free cash flow payout ratio, it drops down to a highly sustainable 56.74%. So that dividend yield of 2.86% is actually safely covered by cash from operations. Plus, that free cash flow boasts a massive 112% three-year compound annual growth rate. The underlying asset generation is pristine, even if the accounting earnings look a little distressed on paper.
Bringing it all together now in Section 5, Final Intrinsic Value Synthesis.
Okay, so when we put all our absolute and relative metrics together, we see a really stark divergence. The fundamental DCF models definitively scream overvalued. Even with generous assumptions on the discount rate, an intrinsic value of $30 is the ceiling. Relative multiples totally confirm this, showing steep premiums across all historical book and sales metrics. Literally, the sole anchor for the current $68.54 price is wild market momentum and extremely aggressive forward-looking growth estimates.
So here is our synthesized impartial takeaway. Based strictly on fundamental metrics drawn from the source data, Kodiak Gas Services is currently significantly overvalued. The paradox is that you have a mathematically sound, high-quality underlying business generating exceptional cash flow to cover its yield, yet it's trapped in a stock price that currently bakes in a negative 108% margin of safety. The asset itself is high quality. The stock price is just completely detached from present value.
I want to leave you with this final, provocative thought to stress test your own assumptions. When a stock's market price outpaces its intrinsic fair value by 128%, are investors buying future cash flows, or are they just buying the momentum? It's a fascinating question. Thank you so much for joining me for this valuation explainer. Keep analyzing the hard data, and I'll catch you next time.